Hey, it's Ivan with Green Financial Solutions, and today we're going to talk about guaranteed income retirement planning, specifically the Market 10 Index. Today, just letting you know, you can find me here, gfsplanning.com. This is our webpage. We specialize in insurance solutions for individuals and businesses. Today, we're going to concentrate on individuals, and we're going to concentrate on the top three bullet points here, specializing in retirement planning, safe money planning, and guaranteed income distribution. So all three of those are together really to kind of help offset the full package of retirement planning. Those folks that are anywhere in this particular case, I think it's going to be best if they're 5+ years away from getting an income from their retirement planning accounts, like their 401ks or whatever it may be. Safe money planning comes into effect because we do not put any of your money at risk. We keep it safe and we keep it growing, and we keep you in an income that you cannot outlive, called guaranteed income planning. And that's the guaranteed income distribution piece of that, which we just basically talked about. But one of the things I want to talk about is a premium bonus that's being offered right now by Equitrust. And the Market 10 bonus is the account that we're looking at today. Normally it's 6%, which means that 6% of any dollar going into the account in the first 5 years, which is great in my opinion. That means you're guaranteed to earn 6% every time you put $1 in that account as a bonus. Right now they're doing 8% instead of 6%, but unfortunately it's ending September 30th of 2024. But there is still time to get paperwork in. If you contact me, all we have to do is get the documents in. We can lock that in. It has to be very quickly. But anyway, normally it's 6%. So I just wanted to throw that out there, let you know that it's going on now. Income for life, or lifetime income through an income benefit rider. If we look at that, let's go back up a few pages here real quick. Let's start with the basics of what an annuity is. An annuity is a contract between you and an insurance company. Really, their job is to hold and to distribute assets. Try to say that fast. To hold and to distribute assets for you. So you contribute money to your account, either in a lump sum or in a series of payments, or both. The money accumulates on a tax deferred basis until you take income from it, and then you start receiving distributions. So that's it, right? You're going to contribute money. This is the hold portion, or accumulate. This is the distribution phase, or hold and distribute assets. You can distribute through partial withdrawals, RMDs, or through income benefit rider payments. Annuitization is something that we're not talking about today. And I like the income benefit rider because you get to own the money and own the check. If you annuitize your money with any insurance carrier that's an annuity, then you only own the check and not the money. So I don't know about giving up the control of the assets. To me, I'd rather you have both. So that's why we do the income benefit rider. Advantages of an indexed or a fixed indexed annuity are protection of your principal and earnings from market losses, also known as downside protection. That means zero is your hero. You cannot lose money in this account. Your growth potential, because it will still grow, and we'll talk about that here in a bit. Tax deferral. Your money grows at a tax-deferred basis. Guaranteed minimum rate of return, which means that you're going to, if it did nothing, you're still guaranteed to have a gain in this account, unlike you would in any other type of market-driven situation. And that is exactly this next phase here. That's the built-in guarantees, and then withdrawal privileges, also known as liquidity. So if we scroll down to page 5, lifetime income through an income benefit rider. A rider is an additional option add-on, which usually needs to be done at the time you complete your account documents in the very beginning. You add it onto a fixed index annuity, and it gives your contract an added or enhanced benefit, usually in exchange for an annual fee. And we'll talk about that as well. Let's see. Achieve your retirement income goals. Guaranteed predictable income payments you can't outlive. Okay, that's the main focus of today's video. Flexibility to start and stop your income as needed. Continued payments to your surviving spouse. And we'll jump right over here, single and joint life options. That's what continued payments to your surviving spouse would be. And I think this is really important these days, because you can get the same income. So basically what you're going to do is make your plan a 100% survivorship plan, which means the income stays the same for both you and your spouse. Something happens to one of you, the income doesn't go away. The income doesn't shrink by 50%. It stays at 100% payout through both of your lives. I think that's great. It also has increased payments in the event of a qualifying chronic illness. So if you lose 2 of your 6 activities of daily living, then you can actually get your income to be doubled for up to 5 years. And I'll talk about that a little bit later as well. The ability to receive lifetime income without annuitizing, which we've already touched base on that. So let's compare fixed deferred annuities versus other financial products. So you've got safety of principal, tax deferral, guaranteed lifetime income, guaranteed interest rates, inflation protection, market index linked earnings, and then growth potential. So savings account, the only thing they've got is safety of principal. CD, same thing. The multi-year and traditional fixed annuity has safety of principal, tax deferral, guaranteed lifetime income, guaranteed interest rates. Does not have inflation protection, does not have market index links, and does not have growth potential. It is a stated rate of interest. That's what you get. Fixed index annuity has all of the things we're looking for. Safety of principal, tax deferral, guaranteed lifetime income, guaranteed interest rate, inflation protection, market index links earnings, growth potential. Variable annuity and stock mutual funds, they don't have all of them at all either. So no safety of principal, no guaranteed interest rate, no market linked index returns. Same thing for the stock mutual fund, no safety of principal, no tax deferral, no guaranteed lifetime income, no guaranteed interest rate, no market linked earnings. They do have inflation protection and growth potential, but you can see that the fixed indexed annuity has all of these things, and you also couple it with the income rider so that you have a guaranteed income that you cannot outlive. So let's look at a real example of what this looks like for the market index. The market 10 bonus index, excuse me. So this is for Mr. Valued Client. He is 64 years old. He has $425,000 in his 401k. And what you see here, he's going to put this in at age 64 and immediately get a benefit bonus of $34,000, which is 8%, and I'll show you that in a second. There will be no additional premium put in. Now, also there's joint life, so whatever the income is, it will be not only for him, but also his spouse. He'll start taking income at age 69, and he'll get to pull out 6.9% of his account value. Now, I want to stop right here for a second because this is important. A lot of people that talk about living on your investments, if you will, say that they like you to take 4% or less, and nowadays it's 2 or 3% because of the way the markets have gone. So when I can tell someone that their income withdrawal percentage is almost 7%, and that's due to their age, by the way, they can take out almost 7% or 6.9%, and it's still guaranteed for life. That's huge in my opinion. That's probably more than double than what you're being recommended by putting your money in some type of market-driven account. Annual income is $46,535. That's for both individuals. That's if both spouses are alive today, and then something happens to one. That income doesn't go down at 50% like it would for someone's pension. It stays at $46,500 for both lives. That's important. Income withdrawal amount equals income withdrawal percentage multiplied by the benefit base. Benefit base equals premiums plus any applicable bonus less withdrawals accumulated at 8% for 10 years, or the start of income withdrawals if earlier. We're going to look at that in a minute. This is an example. Okay, so we've got Mr. Valued Client here is 64. He puts in 425. He gets his upfront bonus of 34,000. That means this value right here is your income base, your benefit base for income. This is how they determine how much income you can take from your account. So you can see right off the bat, it goes in 425 plus the 34 gives you 459. times 8% is $495,720, times 8% is $535,378, times 8% is $578,208, and we can do this all day long until you get down to year 10, and look what we've got here. So this money's growing at 8%. It's guaranteed to grow at 8%. There's no market risk. There's no downside potential. It's all guaranteed, and it's in writing. You're seeing it right here on paper. This is straight from the insurance company's website. And here's the deal. It takes all the guesswork out of your retirement planning. You're going to get 8% on your money coming through the door. You're going to get 8% growth here as well. And it's going to continue to grow at 8% until you pull the trigger, until your 10th year is up, because it's designed to grow at 8% for 10 years. Income withdrawal percentage. This is the percentage up here that we talked about at 6.9. Let's see at age 69. There it is, 6.9%. At age 70, it's 7%. And that keeps increasing the longer you wait. So in year one, in the first year, you have to wait 12 months here to start to get an income. So here's year two, or 12 months later. You're at $495. You got a 6.50% withdrawal percentage, or $32,222. And then here's we go down. Here's the $46,535. Now here's the annual income withdrawal amount with doubler. Now this is the piece where if you lose 2 of your 6 activities of daily living, that your income will double. Now here is the first 3 years not applicable, because this is this is something that they just put on your account at no additional cost. It's part of the rider. And then in year 4, you can start, and you can see the difference here, $38,740 versus $58,110, and it's calculated as well. So if something happens to you, you will be able to get an additional income to protect you from not being able to do those activities of daily living. But it's all here in writing. So Market 10 bonus index, like I said, 8% right now up until the end of this month on the 30th of September. After that, it goes back down to 6, but still a great deal. It'll still grow at 8% on the income base, and it takes all the guesswork out of your retirement planning. Give us a call. We'll be happy to touch base with you about what's going on for you guys. If you're not in the state of Texas, that's okay. We can revamp these to make them for whatever state you're in, as long as the account is approved. This type of account is approved in your state, and that's something we could check on a case-by-case basis. I'm domiciled, and my office is out of Texas, and this is something that we're doing that is approved in the state of Texas. So call us before you need us, because once you need us, it's too late.